for more of that Japanese
Let's do
carry
this
trade,
thing.
either the fear of the carry trade or that sudden unwind. It's the shifts in policy. We're seeing volatility.
Why is this happening during Windows 11? This was never happening during Windows 10.
Yesterday, a lot of people are pounding the pavement going, oh my gosh, Michael Burry is right. But if you actually watched my video breakdown of what the catalyst for pain yesterday was, it had very little to do with Michael Burry being right or wrong. It doesn't really matter where Michael Burry sits because the Burry problem is a long time in the future issue. It's not a now issue. Instead, what you really want to pay attention to, in my opinion, is the potential default of a company like CoreWeave. That is critical for this AI play. And right now, fortunately, we're getting some recovery on the Qs. We're coming back to 595. My expectation, my hope was that we would go bullish today. But I will say we had a lot of selling we had to get through at the AM. AMD went down. NVIDIA went down the first, 2-3 hours.
Whatever. We're just going to have to live with it. If you're on YouTube, I can see your comments and questions. I'm going to do a little breakdown on Next Era Energy. $8 billion in revenue. $3 gigawatts of renewables and storage into their backlog. What is NEER? Next Era Energy? That's only 3 R's. Next Era Energy. It's just a weird acronym. NEAR? Whatever. Okay, so it's a company. It's called NEE, Next Era Energy. It's utility subsidiary, Florida Power and Light. Okay. God, this computer is like, has the best GPUs and it's so slow. The mouse pauses. The streaming shuts off. What is going on here? It says encoding overloaded. Consider turning down video settings or using a faster encoding preset. I'm using NVIDIA NVEC for the video encoder for the streaming. I turned down the bit rate to 2000. I have the tuning at ultra low latency, but I don't think that matters. What is going on here? I have the preset at low quality. This is so ridiculous. God damn. The world's largest generator of renewable energy from the wind and sun. Wow. Okay, $8 billion of revenue. Slight increase year over year, or whatever. Revenue slightly missed estimates. Earnings per share beat consensus. The stock looks like this. Oops. NEE. Big sell-off on earnings, still holding. $34 gigawatts of net generating capacity. $34 gigawatts. Trump's energy stocks will help you retire early. I'm not a financial advisor, but many financial advisors might say that this company is the most likely candidate to provide energy for the next era of data centers and AI. And the company is Next Era Energy, ticker symbol NEE. They are the world's largest generation capacity of wind and solar. So what does that mean? That means that they could provide up to 34 gigawatts of energy, according to the Department of Energy, from wind and solar. Sam Altman is calling for 17 gigawatts, so about half of that. Well, that's exactly half of that, but it's really unclear what Sam Altman actually needs. But with NVIDIA, Oracle, SoftBank, that's the number that's being floated around for the near term. And then 8 years from now, it'll be 10 times that, according to him. But here's the deal. No matter what happens with OpenAI, this energy is starting to get built out. And this company is well positioned right now to get some of that deal flow. The ticker is holding up on the stock chart. And the Q3 earnings revenue slightly missed estimates. It was up year over year. Earnings per share beat. And earnings reaction isn't great, but over the past couple weeks, any earnings reaction that holds where the stock was before earnings is actually pretty good relative to a lot of other companies releasing earnings and relative to the market, which has gone down. So let's jump into a little breakdown on NEE.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, so here's the deal. It's hard to say where this energy is actually going to come from, right? To provide the 17 gigawatts that's needed for maybe the next year, next few years for OpenAI and for their competitors, Anthropic, which makes Claude, which is another LLM like Google Gemini. Next Era is definitely in the conversation because that Department of Energy quote of calling them the world's largest generator of wind and solar. Wind and solar is great not only because these big tech companies want to be associated with wind and solar. It's green, right? Call it greenwashing, call it environmentally conscious, whatever it is. Wind and solar is growing like a weed. So unfortunately, it's really intermittent. So you do need other energy sources like natural gas in the meantime. And we've seen the price of natural gas go absolutely, I was going to say nuclear, but it's not quite getting there. It's sort of higher than it was a month ago, at a time when nuclear stocks have sold off significantly. So the timelines for all of this is pretty up in the air, but natural gas futures are up slightly, at the same time as oil is down as well. So I'm not saying that you put your money where, you know, things have already gone, right? You want to buy the stocks before they go up. And that's the reason I think Next Era Energy is interesting. I'm not going to say go buy some natural gas company just because natural gas is up right now. There is no wind futures. There's no solar futures. If there's some type of analog, let me know in the comments, but I don't know of it yet. What we do have is public companies, and this company actually owns a public utility, Florida Power and Light, which is definitely at the cutting edge of renewable load balancing. So what that means is, you know, wind and solar is great. It's great that they are arguably the world's largest, right? Florida Power and Light is the largest rate-regulated electric utility as measured by retail electricity produced and sold. So they have a lot of customers, is all that means. Florida is a big state, and it's just one big company serving a bunch of them. It's not, I guess California must have a bunch of different companies in there. So Next Era is kind of the test case because they own Florida Power and Light, and they also own this clean energy business. And together with that clean energy business's subsidiaries, affiliates, whatever it is, they are the world's largest generator of renewable energy from the wind and sun and a world leader in battery storage. So this is a big company. Look at that market cap. I'll minimize this here, but 150 billion market cap. So this is a massive public company with a serious research arm, getting all the load balancing in place, the pumps. You know, you can actually use pool pumps to regulate the electricity grid. Believe it or not, Florida has a ton of pumps that turn on and turn off. People like to clean their pools, and you can use that to balance the grid. So this sounds crazy. Believe me, this has been happening for a decade now. And now it's finally needed because there's this AI requires all this power. So it's all coming full circle. This permitting can take years. There's a lot of other companies that also were going to be implicated in this power build out. Dominion, Entergy, Bloom Energy is like the bridge company because they can set up remote power. If you look at Entergy, you can't buy it right now. It's basically following the price of oil right now, it looks like. If you look at Dominion, it's actually setting up pretty well. This is pretty interesting, pretty big base. I would definitely put this on a watch list for sure. It's just a little slow. So I think NE is the stock to buy right now. And look, I mean, sure, this is a big sell-off. But if you look at other earnings reactions so far, this earnings reaction is pretty solid for Q3. So that's the idea. Hit that like button if you like these ideas. It helps the YouTube algorithm show this to more than the 10 views we've been getting recently after YouTube cracked down on one of our titles. Don't quote me on what I just said, but that seems to be what's happening. I could be wrong. Hit that subscribe if you want a free course on how to buy stocks, and go to stocksmedia.com to sign up.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Okay.
Here we were straight down on Nvidia and AMD. Fortunately, it seems like some of that selling flush is now behind us. Volatility's coming down, and unless you're in fat brands, you should be seeing a recovery today. Now, we've been dumping on fat brands for the last couple days, over 2 or 3 days here, mostly because I can't believe a company with $2 million of cash has over $1.5 billion of debt. But that's really a topic for a different video. But what you'll notice is there's a lot of buy the dipping going on here. You've got Target.
All right. IBM is confusing. 10 billion in revenue from AI. Earnings per share beat. Buy every share of this company that you can. Not a financial advisor. This is not financial advice, but many financial advisors, I think, would say that the research I have gathered suggests that buying as much as possible before November 26th is a good idea. The company is IBM, ticker symbol IBM, the original AI company, the inventor of Watson, of Jeopardy fame. This company has been a mainframe mainstay that fell off when people moved to the cloud. Since then, there's been an increased focus on security and on-prem installations of servers. So IBM is getting some of that business. With AI, it's great that all of these AI companies can manipulate your data, but what the big enterprises actually want, banks and all that, is for their data to be stored securely. And so somehow IBM got a slice of that market again, because they've been doing it for 50 years. Notably, they had 10 billion of revenue from what's called generative AI services. So generative AI includes any type of manipulation of documents, summaries, anything that is basically what ChatGPT does, IBM is doing as well. So it's not, fruity picture generation or style transfer or anything like fake videos or anything like that. Generative AI includes all of this stuff that's very important for big law firms, for hospitals, anywhere that a lot of textual data is stored. So IBM beat earnings. They have that growing revenue segment in the hottest vertical in the world, generative AI. And there's increased demand for what they're already an expert at. So let's look at the chart and see why on-prem is interesting still.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Here's this earnings beat, and yeah, it was weird, but in hindsight, it was definitely a solid reaction because it sold off so much. It's just crazy to have it sell off and then have a huge green day and then you have a huge day up. But anyway, they're at this important level right now that's held from, what is this, June? So this is pretty notable moment. Nice time to buy. So of course, if it does sell off, you can sell right out. You have this little shelf of risk. It's right near this psychological $300 level as well. So as for why now on a more high level scale, it's kind of scary to think of buying IBM in 2025, right? They're not going to be OpenAI. OpenAI is going to be OpenAI. But they do have some serious long-standing advantages in governance and infrastructure. meaning on-prem server installation and maintenance, and then security level agreements, how often they're going to fix things, how often uptime they're putting into their contracts, how the data is stored and warehoused and separated and all that good stuff. That's where these guys really matter. So sure, they're boring, they're old, but they're actually really good at AI. They just don't have the brand, and obviously don't have a consumer-facing product like ChatGPT that I'm using right now that has almost 1 billion monthly users, which is insane. I mean, I can't even believe that, saying that out loud. That's really came out of nowhere. So here's the deal. They've been investing in R&D for years, and there isn't really a lot of public ways to trade or invest in these models, right? These models are, some of them are open source, and then they're forked into closed sourced variants. The OpenAI models are not open source. Meta did open source their Llama models, and you can't just invest in Meta's models because Meta is a massive advertising business, right? It's like Google. It's a lot of things. So they don't really have competitors that are public in terms of ways to invest in generative AI. They do have a partnership with Anthropic, which is kind of advantageous to partner with the company that doesn't have a agreement with Microsoft. I mean, OpenAI has an agreement with basically every company now. With all of this, you pay me, I'll buy your chips, which helped AMD, which helped NVIDIA to an extent. Didn't really help Oracle, I would say, at this point, given that Oracle is actually down below its current level before the OpenAI agreement. So the OpenAI guarantee, this handshake deal, the press, the PR is slowly losing its luster. And it makes companies who are actually using AI and who are in these really old established industries really attractive. So that's the pull for IBM. As I said, their strength is actually something that who knew would be really important still, but on-prem deployments is extremely important. Not every company wants to be in the cloud yet. So they do have a cloud business, but they're really focused on these industries that are extremely safe. I mean, healthcare with HIPAA data, government, which in general you have to be really careful to get those contracts. So the story, of course, is nobody ever got fired for choosing IBM, and it still seems like that is the case in situations where the data has to stay on the server. So they are partnering with Grok. This is GROQ. This is Chamath Palihapitiya invested in this company. It's a chip company. So they have these partnerships with Grok and Anthropic that are very modern companies that is allowing them to sort of weasel into the modern tech conversation while still having all of the security that they've had for years. Which any way you can reduce costs is a good way to get your foot in the door. So that's IBM. It's kind of what you'd expect with a new twist. So that's the idea. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. I'll post that once a month for subscribers. And if you want one-on-one help, head over to stockscommunity.com. I'll see you in the next one.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Up 5%. As they're offering a 5% dividend, people are buying the consumer dip. Chipotle, which has been tanking, is getting a bid, up 4%. Red Robin, which is issuing $40 million of stock because they're out of money, they can't pay their bills. They have horrible financials. They're up 5% today. Dave & Buster's, which screwed up massively on CapEx spending, is worth less than $500 million now, up 5%. Cheesecake Factory, Macy's, a lot of these consumer...
Cheesecake sounds so good right about now. I don't even eat cheese. Flex. Let's talk about this company, DHR. Diagnostics and Research. It's a big consulting company. Q3 earnings almost $1 billion. Revenue $6 billion. Free cash flow $1.5 billion. Biotech bioprocessing. This company is large. Thermo Fisher. Life Sciences Tool. Okay. Donner, 130 billion. This one stock can change early buyers' lives. It's not financial advice, but financial advisors might say to buy as much as possible before November 26th. The company is Danaher, ticker symbol DHR. They do life sciences tools, diagnostics, and as money has flowed out of semiconductors, the Mag 7, and to some extent even oil companies in the last week, money's flowing into life sciences, pharmaceuticals as well, biotech. So the market is down, but the market is made up of 30 to 40% of big tech. So money is flowing somewhere. It's not just going to cash, and these life sciences companies are benefiting. Danaher, they are benefiting from an increase in at-home and affiliates using their tools to do testing. So you can test your blood at home and then send it in. You can go to an urgent care center. All of these places where life sciences tools are needed are becoming more attractive, more convenient. And this is a big company, 150 billion market cap. They have over $1 billion free cash flow. So that gives them some flexibility. If tools aren't doing perfectly well, they can funnel some of that money into AI diagnostics. AI applications are growing for life sciences, drug discovery, etc. So best places to always invest in are healthcare and education. And right now, it seems like healthcare is the place where the money is flowing. even as the economy looks shaky. So this is not really a rate cut sensitive company or sector. They're right up there with another big company, Thermo Fisher. And research is still needed for a lot of these big diseases, cancer, etc. That no matter who the administration is, these labs, these public companies need money from the government, from investors to buy these tools. And these tools are sold by Danaher. So it's the picks and shovels for healthcare. Let's jump into a little breakdown.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, so this is a little bit about the inflows to the healthcare related ETFs right now. I mean, we can just see this on the chart for XBI. A health tech ETF HEAL is actually pretty specific. If we look at that one, it doesn't look great. But if we look generally at healthcare, PPH, pharmaceuticals are up. XLV looks crazy up. Biotechs are doing well as well. XBI, LABU. And then if we look at DHR, definitely up. I'm not even sure DHR is in that healthcare ETF that ChatGPT just pulled up, but Thermo Fisher as well, holding up really well. So it's not to say that these companies are going to double. They're slow moving. I mean, this moves 3% a day, but the most recent earnings was solid. And at a time when the other stocks in the stock market are selling off, I mean, name a stock, it's not doing well. AMD is the first one that comes to mind. I do think that just because Nvidia sold off doesn't mean that the whole market is completely cooked. Futures just opened as I'm recording this video about an hour ago. So a little bit of a gap up, but not anything major. So I don't think this is indication that the whole market is definitely okay. I mean, we have this massive drop and then this tiny rebound. And then this gap up is nice, but it's pretty to be determined. I mean, we had this little gap up on last Sunday, and then Monday was a big sell-off. So pretty rough week. We'll see what happens, but wouldn't be surprised to get a chop for a month or two. No one knows what's going to happen with macro, but that's the backdrop that makes a life sciences company that moves 3% a day interesting. Not to say that there aren't other companies that I've mentioned that are interesting. Walmart is interesting. Recent earnings, but that's a different pattern. You know, you're buying off of earnings that just happened. This one doesn't trade 24 hours, so we'll see what it does when it opens tomorrow. I'm just saying that some companies do open right now. Walmart does not, so I can't really tell you what it's going to do, but 105 is the level. So there are ideas that might be great buys off of earnings. But in terms of just where money is flowing, healthcare and healthcare tech, Danaher seems like a good spot to buy, a good company to buy. There are a lot of ETFs that are more specific, sort of genomics. I'm not going to get too deep into these. I more focused on, yeah, exactly. ETF flow data is noisy and very lumpy. So especially when some of these ETFs, I mean, we can look at this ARCG, this genomics ETF, but you have to be careful because a lot of these are kind of a liquid. I mean, it is moving up slightly in the past few days, but this entire ETF, HEAL, only trades like, what is this? This is some sort of joke. 30 times 10,000. I mean, yeah, this is an ETF, but this could just be some financial advisor set this up so that he could basically make it easier for clients to just invest it as ETF rather than giving them custodial rights to their banking logins. So anyway, DHR looks good. The larger ETFs look good. XLV is the most important one for healthcare. So we can go into exactly what this company does, but if we're being honest, really we're just looking at the chart and saying they're in healthcare, they're in tech. So it's a forward-looking sector of tech. And this is a large company, 130 billion, that has been around and is starting to shape up at a time when the market's shaping down. So that's the idea. If you like these ideas, hit that like. If you want a free course on how to buy stocks before they go up, hit that subscribe. If you want one-on-one help on a Black Friday $19 deal, hit the first link in the description.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Boomer beaten up stocks are rallying today. And I think a lot of it is because of the belief that the Federal Reserve is going to come prop the stock market up. And frankly, you kind of want that. You want the Fed to pump the bags. Because if a company like CoreWeave goes bankrupt and it goes full circle, much like Circle stock did, going full retrace here, full 100% retrace all the way back down to the zero line. If CoreWeave goes full circle and we go down to 33 or worse, CoreWeave goes bust, you have to understand the greater implications that it's going to have for NVIDIA. See, I wrote this note yesterday.
I don't know if CoreWeave really is going to have an effect on NVIDIA. I could be wrong, but I feel like they're not that connected. CoreWeave is like in their shadow. $60 billion company, monster. So let's see. What did Monster do? $2 billion net sales. Sugar-free and low sugar variants. U.S. energy drink industry expected to grow 10% through end of 2025. This one stock can change early buyers' lives. I'm not a financial advisor, but financial advisors might say to buy as much as possible before November 29th. The company is Monster Energy, ticker symbol MNST. And if you're not a Monster drinker, you haven't seen it in a store, you've heard of Red Bull. They're like Red Bull. Tastes a little different. So the energy drink category is up 10% compounded annual growth rate for the next, 10 years. That's the projections. I'm not an energy drink drinker. I've tried them, but a lot of people are, and they help get people through the day. So it's crazy to say, but one of the best performing stocks in the last couple of decades is Monster, right next to Domino's Pizza. So people love vices. I love vices. I like pizza. And right now, this company has $2 billion in net sales. partially driven by strength in sugar-free and low sugar Monster versions. I don't know what they're called. Someone can tell me in the comments. I'm sure they have a cool name or something. So let's jump into a little breakdown on Monster, why now is the time to buy this. Coca-Cola's up slightly right now as well. And a little bit about Q3 earnings. It's not financial advice. I'm not a financial advisor.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Okay, so this is Monster. This is kind of what they're up to. This is something I was a little bit worried about is other competitors. You look at Celsius. Celsius has been advertised a lot online. It's a big hit. If you look into stores, you'll see Celsius. I swear, as soon as I said it, now you'll start to notice it. There are other ones that are kind of online marketed and grown. But they have the distribution that these other companies, I haven't seen them in gas stations. I don't think that that's going to change anytime soon. So they are focusing on low sugar. There are some wellness oriented health energy type drinks, but it doesn't seem like that's a problem right now in terms of how much they're selling. I mean, 2 billion is no joke. They have a serious brand. They have a whole marketing engine partnering with action sports athletes, and they're around the globe. So they actually acquired one of these competitors. This is a pretty big competitor too. I can't really say exactly how good the product like I said, but I do know that it definitely gets people through work, through school. And here's actually the name for the sugar-free line, which is a cutesy name. So here's the company, Monster. And if we look at the actual stock chart, it looks excellent. There's the earnings most recently, a little beat. This is what I'm talking about over the last 20 years. Absolutely crazy growth. This is like an NVIDIA type move, right? But almost even more interesting that it doesn't really have many sell-off periods. This is COVID, right? No sell-off basically during COVID because they sell energy drinks, so you can still, I guess, walk into a gas station and buy them. I mean, this barely didn't move at all. It's crazy. Essential workers were buying a lot of them. I'm not going to speculate on that, but 2022, when the market went down, this company just went sideways. It didn't go down much. And then sure, it did get hit a little in 2024, but it didn't have any problems with tariffs. So it basically is like some type of fantasy stock. And just to put it next to Domino's, Domino's also with a crazy run. Did have a little bit of pullback in 2022 with the rest of the market, but that's sort of what you'd expect. I mean, like everyone is, I mean, NVIDIA is just insane, but everyone is looking at NVIDIA and saying, okay, there are definitely periods where stocks go down. This is 2022. So to see Monster just look so strong is crazy. Is this going to happen forever? No, but that's why we use levels, right? So you can buy it off of this 72 level, look for a move up to 80 or so. And if it sells off, it sells off. But Coca-Cola seems to be doing well recently. Some volume coming in there. As far as food in general, it's not doing great, I don't think. Shake Shack's down. Eat okay, but down for a while. So energy drinks, I mean, that's a good business. So here's the deal. This is a problem, right? Store traffic declines. People just aren't going out and buying things as much anymore, except for they're buying food. They go to restaurants, but they always have to get gas too. So this seems like this is likely to hold up, but it's something to be aware of. I'm sure you can buy them on Amazon and have them shipped to your door. I don't know if there'll be any crackdown on basically sugary and caffeine drinks, but we'll see. Anything could happen with this administration. And here's that growth. Coca-Cola had some revenue growth in Q3. So that's positive for the beverage space in general. Celsius had a large increase. That's that competitor I was talking about earlier that has that big online presence. 700 million revenue in Q3. So that's a big deal. Looks like they had a little bit of a distributor situation, but definitely holding up. Let's look at that ticker just to make sure we're on the same page here. Okay, so that distribution payment definitely wrecked this company. It sort of reminds me of Meta's one-time 15 billion hit. I mean, that's down a lot too. So not the best earnings, but fortunately we can see that this move is based off of earnings. It's not the stock or the sector itself looking weak. So that's good to be aware of. And then Keurig Dr. Pepper, one other competitor just to be aware of, seems to be doing well. Revenue up 10%. And they acquired an energy drink company. So that's makes them a little bit closer to Monster. So if we look at how they're doing, looks like the earnings was kind of a nothing burger. I don't know what this is, but this is definitely not related to Monster or the category. This was 6 months ago. So Monster looks good. That's the idea. If you like these ideas, hit that like. If you want a free course, hit that subscribe. And if you want one-on-one help, go to stockscommunity.com.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
In the Meet Kevin app. NVIDIA is basically a bank. And so what I wrote is, let's ignore inventory for a moment. Let's just assume that the inventory issue is just part of their increasing sales at NVIDIA. What's more interesting at NVIDIA is actually its accounts receivable profile. Now for this next one, you're gonna wanna remember Gemini.com/Kevin because you're gonna get a bonus with it. Most people want to invest, but between work, bills, and everything else, it is easy to forget. And that's where today's sponsor, the Gemini credit card, comes in clutch. Gemini lets you earn Bitcoin automatically on every single purchase you make. Think about that. You earn 4% back on gas and transportation, 3% back on dining, 2% on groceries, 1% everywhere else. And the rewards are deposited instantaneously in Bitcoin or any of the other 50.
Okay, that's enough Bitcoin talk. If you are on YouTube, I can see your comments. Go ahead and ask questions, whatever. This is live. Or it is right now. Obviously the recording won't be. So 175 billion revenue for Thermo Fisher. Life sciences, consumables. Okay. Let's just talk about the earnings again. See how the earnings were. No crazy. Everything's up. All the segments of revenue where we're up. They did a collaboration with OpenAI. So 11 billion, up 5%. Okay. Thermo Fisher. There is one stock that is about to skyrocket at 11 billion in revenue, up 5%. Excuse me. They are a life sciences company. The ticker is TMO, Thermo Fisher, and they have strong recurring revenue. They continue to sell their reagents, their solutions to labs, and you can imagine governments who are working on biotech projects, hopefully for the better, continue to reorder. So this is kind of the picks and shovels for healthcare. They also have a partnership with OpenAI where they're using their APIs in order to speed up clinical trial times, so decrease the time between trials, and also help with filtering candidates for those trials. So AI does well with that, looking at characteristics of people who might be a good fit for a candidate and quickly coming up with recommendations on who could be a good qualified candidate. So Thermo Fisher is the company. They move very slowly, 2 to 3% a day. That's why a 5% revenue growth is good for a large company. So hundreds of billions in market cap. Let's jump into why this company is well positioned right now. Money's flowing out of big tech and into healthcare. It's not financial advice, but hopes it helps.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, so this is Thermo Fisher. This is the market cap, 175 billion. Annual revenue exceeds 25 billion. They have a bunch of different customer segments. The big ones being government and labs. And this is the OpenAI partnership. So Thermo Fisher has all the data, right? And this is the real moat. Startups have to license that data from big pharma companies like Thermo Fisher. I don't know if they would call themselves a pharma company. They're a life sciences tool company. But they're a great candidate for ChatGPT, the enterprise version. Drug development is going to use a lot of tokens for sure. And that's sort of a longer term growth play. But if they can just make clinical trials faster, that turns into faster drug development, not necessarily using the AI to test all the different molecule types and come up with a new drug. It just saves them money on R&D in general and automates some of the boring boilerplate documentation. So it's kind of like how we use LLMs as a consumer on ChatGPT is how they're using it. But this is a step for sure. And they do have this longer term play, which is more in the drug development direction, to use AI to predict how drugs are going to behave, making drug development faster. So they says that they are saving 25 to 60%, which is a big savings just on documentation that you can imagine any time of life sciences or healthcare company needs to document a lot to be compliant with FDA and with HIPAA and everything like that. So it's actually a good move for OpenAI as well to show that they can operate in a very secure environment. That's the OpenAI collaboration. OpenAI has a lot of collaborations, so I'm not going to say that the stock price is too hinging on that, but it's a nice, at least, proof that they're trying to grow because they're such a big old company. 11 billion in revenue, up 5% from a year ago. And if we look at the actual chart, they're a slow mover, 2% a day right now over the last 10 days. Of course, they've gone sideways for a good period of that. But this is the recent earnings. Their earnings per share was a slight beat on earnings alone. And then they held, interestingly, while the market sold off. And we can see that crystal clear. Although small caps are starting to have a little bounce, possibly. We'll see how that holds up or if it does hold up. The SPY is pretty ugly. This bounce on Friday barely got us much above this 1010 rare earths China Trump low. So now the question is, where's the money flowing? And the money seems to be flowing into these life science healthcare companies. We can see that in the healthcare ETF and in the pharmaceuticals ETF. These numbers aren't crazy, like 3% year-over-year organic revenue growth, but all of their business divisions are growing. Life sciences, instruments, especially diagnostics, maybe in-home or urgent care. And then their lab products and services are also up. So everything seems to be very strong and recurring. And you can imagine, like, if a lab starts using Thermo Fisher, whether it's a commercial or a research lab, they're just going to keep ordering from them. It's kind of like having a, you know, LL Bean or like a, whatever it is. I can't think of a men's clothing catalog, but I guess LL Bean is good enough. You just keep using whatever you already use to order your product. So they're a massive company, and they had this beat on revenue as well as earnings per share that we just saw. Margin increased. This isn't a super exciting company. It's not, you know, the next quantum company. It's not the next, 23andMe. But I think that's actually a good thing in terms of investing right now. You want to be really careful. Here's some similar companies that you're probably aware of. Agilent is another slow moving one that seems to be holding up. I think they make, like, scientific calculators as well, but they also make the lab tools or microscopes or anything like that. So they do have earnings coming up tomorrow at the end of the day. But here's the play. If Thermo Fisher, okay, here's really the backdrop. We just saw futures gap up this weekend. So if Thermo Fisher gaps up to like here, you could just buy it on a breakout with a close stop out. And if it fails off the open, then you just sell it, right? Or by the end of the day, you sell it, whatever your schedule entails. But if you want to be a little bit more discerning or careful, maybe you just don't touch it for like a week. And then if it holds up, then you have an even better opportunity. Because see how it went sideways for a week and then moved, sideways for a week and then moved? That's probably slightly more likely. So that is a way to play it instead of just buying the breakout. Although people like to buy on Mondays and stocks tend to move on Mondays because people get excited. They're all pent up from the weekend. And I think that's could be the case for their sister company DHR as well. So that's the idea. If you like these ideas, hit that like. If you want a free course on how to buy stocks before they go up, hit that subscribe. And if you want help in a Discord membership, head over to stockscommunity.com. You can see some testimonials on that page.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
AutoZone, bro. What could be more exciting than AutoZone?
50 plus cryptocurrencies that you can choose from. So no more waiting for points or tracking expiration dates, no extra steps. It's a simple way to get exposure to crypto while living your everyday life. Just swipe or tap or however you use the card and earn.
That's just what I need.
Here's the stat that sort of puts all this into perspective, which is pretty epic. Bitcoin rewards historically held for 1 year on the Gemini credit card have appreciated on average 279%. Now, of course, that is not a guarantee. Crypto is volatile. It can go up and go down, but it shows the potential of having long-term upside from your credit card.
Leading retailer and distributor of automotive replacement parts. I think this earnings was good, right? What is this rally? 30% year to date. Same store sales are up 5%. Opened 140 new stores in the quarter. Wow. Okay. There is one stock that is about to skyrocket. The company is AutoZone, ticker symbol AZO. And at a time when money is flowing out of big tech, flowing out of speculative names like quantum, like rare earths, money's going into healthcare, money's going into pharmaceuticals, money is going into, to some extent, energy drinks, and aftermarket automotive part companies, retail locations. This company, AutoZone, 5% same store sales growth year over year, 6 billion net sales, and they opened up 140 new stores. So it's very clear that a lot of retail is having a really hard time, right? That's just going to get worse. Commercial office space is not really doing great either, unless it's in super high-end areas. What is working is people still need to eat at restaurants. Well, they don't need to, but they like to. People still need to go buy gas because they like to drive around. And they need to fix their cars too. So these automotive repair shops, AutoZone, are having a little moment right now. O'Reilly Auto Parts is also having a moment, which is another brand name you might be familiar with. So let's jump into the chart. Let's jump into what AutoZone has been doing in other markets like Brazil, which is a massive market. And let's see why AutoZone is looking good right now. This is not financial advice, but hope it helps.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, so here's that net sales number. Here's that same store sales growth, which is awesome. And then 140 new stores, and that includes other countries like Mexico and Brazil. So those are massive markets. Here's the deal. This is what's interesting. This is kind of a recessionary proof stock. I mean, maybe we can sort of battle test that. If we look at a 5-year chart on AutoZone, here's 2020, right? Can we see that on a quarterly basis? It's good enough, right? This is the dip in 2020, which sure was a little dip, but immediately bought back up. And by 2021, big run. Here's a little bit of a dip in April of 2024. And then here's the tariff dip last year. But those dips kind of just got bought up. I mean, even over the last 5 years, you can barely see anything. This company has just gone up. And if we compare it to O'Reilly, also a massive move up. So these companies basically look identical on the chart right now. So this is O'Reilly. This is AutoZone. They trade the same. People who are buying AutoZone are buying O'Reilly. Someone might even be buying both of them in automated fashion, some sort of fund or something like that. But we don't really need to worry about that in general. We just have to look at the liquidity and say, this is crazy. This is a $3,000 stock, but it's only $100,000, 100,000 shares a day. So this is like $400 million a day. Super liquid. And earnings is coming up, but not for about 3 weeks. So you don't need to worry about that right now. You got a nice level to risk off of. Pretty clear move up after a sell-off. And as the market's selling off, AutoZone is holding up. So that's the story of the chart. You know, story of 1,000 words or whatever. There are some challenges that they might face. You know, rising fixed costs, inventory levels, the whole tariff situation definitely could hurt them. Although, like we just saw from the chart, it doesn't really seem like it did much. I mean, there was some of a move down, but pretty much it was choppy. It was definitely choppy. We'll give it that. Not as bad as some other companies for sure. The other risk factor is electric vehicles might not need as much replacement parts that are more traditional, like the brakes, the filters, the belts. Obviously, you still need brakes for your electric vehicle, but I could see how a battery-powered vehicle just has less moving parts, I guess. So we'll see what they do. But right now, it seems like they're opening more stores. So, you know, rents also might be more appealing for some of these companies that are able to weather the storm of the death of consumer retail, commercial space, whatever. The stores that survive are, I mean, you look out in your mall and you see them. It's like Kohl's, maybe, Target, and then some little niche stores, one of them being like a mattress store, which works because you sell one big product and the salesman gets a commission, and you can have one person in a whole store. You don't have to have much overhead. And I don't know if that's the case. I haven't walked into an AutoZone recently, but I could definitely see how it's not like you're going to get your car fixed at AutoZone, right? If anything, your mechanic is saying, hey, you could go pick something up at AutoZone. So that's kind of the story and the angle. As far as why it's not falling right now, well, it's not part of that Mag 7 30% of the market that holds the market up. So it really has nothing to do with AI either, which is the worry about the AI bubble right now, that the market might be selling off because that bubble is finally starting to pop, or at least show signs of not growing as much, which of course for the market means a slowdown because the S&P is balanced, right? It's the best, fastest growing 500 companies in the world that are US listed. So with all that said, AutoZone seems sort of sheltered, and we'll see what happens. As they release earnings, we'll see what happens with O'Reilly, which seems to be trading almost identically. But yeah, this is definitely the two companies to look at, O'Reilly and AutoZone. They literally move the same. They both have big brand recognition, retail channels. You can walk into the store, and these other companies are fine. They just also do oil changes, brakes. We can take a look at the tickers just so you have the tickers. Tractor Supply, I'm sure you're familiar with, Monroe, MNRO, and GPC, and Advanced Auto Parts. But Advanced Auto Parts is not doing so well, and Tractor Supply is really not that related. Monroe does oil changes, as we mentioned, and this one looks like does industrial parts as well. So the O'Reilly is really the best analog. So that's the idea, AutoZone. If you like these ideas, hit that like button for the YouTube algorithm. If you hit that subscribe, you'll get access to a free course on how to buy stocks before they go up. I post that in the YouTube post section once a month. And if you want to take advantage of that $19 Black Friday deal, head over to stockscommunity.com. Give it a shot.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.